if things are successful, it's very easy to attribute that success to your skill. But a lot of the time, things can be out of your control.
And that's what the book talks about. It talks about like most people, when things go right, they'll say, hey, that was my skill. And when things go wrong, they'll be like, oh, I had bad luck. And they actually do the opposite with other people. When they see things go right with another person, like, oh, that person's just getting lucky. And when they fail, they're like, that was their skill. And so we have this like kind of double standard. And the best decision makers, and they're starting to analyze it, these various decision makers in the book, they're constantly looking at like, how do I get better at making decisions? And how do I reduce the factor of luck and in those decisions, and then be honest with myself. So one of my favorite activities is I'll go back and I'll review every scrap of material I have on past investments from 2, 3, 4, 5 years ago. Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Xan Wood, a dynamic investor at Canvas Ventures, where he leads seed to Series B investments in data infrastructure, AI, ML, verticals like fintech and digital health. He has a rich background spanning early stage funds, climate tech, emerging markets. Xan has a unique perspective on growth and inflection investing, so we're excited to talk to him about that. From founding Moonshot events in Edinburgh to launching Courtyard Ventures at Berkeley, his journey is unparalleled. I'm excited to have him on the program. Thanks for coming.
Thanks, Brian. Excited to be here. Thanks for having me.
Yeah. It's been kind of years in the making. Well, I'd love to kind of just start at the beginning. Tell us about who is Xan and like how did he end up in venture capital?
Yeah, it's been a bit of a roundabout journey to venture. So originally from the UK, I went to university at Edinburgh where I built up a fairly large events business. Decided on leaving university, events is the older you get, the harder it gets to keep on going out. So then exited that business, moved out to Asia where I was involved in private equity, private credit. For about 7 years, and had been in Asia about 7 years doing all this. And I was actually born in Singapore, so I'd nearly spent half my life in Asia by that time. And so after about that, we were there during COVID, during Hong Kong. We're like, hey, why don't we go try something else? And that something else was doing an MBA. Coming out to the US, my initial theory was maybe to get into private equity in the US, but then came out to Berkeley, got involved in the ecosystem, and realized that private equity in emerging markets is actually a lot more similar to venture capital in America versus private equity in America. And so realized that my skill set was probably better for this kind of like earlier stage investing.
Yeah. What kind of turned you off on the kind of the later stage, more traditional US based private equity versus kind of the early stage venture?
I don't think it's like a specific turn off. For me, I just love the investing side. So I love like every aspect of investing. I think more of the similarities maybe between emerging markets is I think everything in investing is people driven, but I think earlier stage is a lot more people driven. I think in emerging markets there's always problems, and so it's a lot about problem solving. And I think venture capital is always problems. It's never up and to the right with these businesses. And so the problem solving aspect is pretty nice. Where like I think if you're in like bulge bracket buyout, you're not like that close to the business. You're more making changes on an Excel versus kind of getting really down to like the brass tacks of the business, which I find a lot more interesting and rewarding as well.
Me too. I really like the early stage stuff. To answer my own question, when I looked at the private equity stuff, it just felt like more CFA stuff for me, because I had the CFA like 20 years ago, worked on Wall Street, and I was like, I don't want to do more of this, like just sitting in spreadsheets and kind of looking at discounted cash flows and kind of future exit scenarios. I want to like be at the tip of the spear of what's possible.
I also did the CFA, and actually like that I think is pretty useful in like you really because at the end of the day, all these companies have got to get to be big companies. And so I think you really need to understand like how is a company going to be valued on exit? How is a company going to be looked at? Like, if it's a roll up, is it going to be looked at in a specific way? If it's like, what is the multiple of that business? And also like, what is like a margin profile of this type of business at scale? And so I think like having that more like financial background is pretty good discipline to kind of get into the earlier stage investing as well.
It's kind of weird. I always discount my finance background, but take that with a grain of salt, because I mean, I think being able to understand that world is helpful, especially as you get into the mid and late stage, to your point.
Where we sit at Canvas, like we're kind of straddling it. Do you know what I mean? Where you've still got to bet like very specifically on the founders and the business, but at the same time, like where we kind of eventually get to is, people who come after us and are a little bit more metric focused, a little bit more financial focused. So I think like, setting up a business for that is also pretty important as you kind of build the story for net future rounds.
Well, let's go back to, so you got into Berkeley, you came to the States, did your MBA, it sounds like, and then kind of what happened next?
So, pre-arriving at Berkeley, I read like a news article about some people at Stanford who had like launched a fund which invested in like Stanford funds. So, prior to Berkeley, I remember emailing one of the professors. I was like, hey, this should happen at Berkeley. And then I was introduced to a guy called Kevin Chang who'd done it before, basically. He'd done like a similar thing before. So I got chatting to him, and then myself and a couple of friends on the MBA, we raised this fund, which is a fund called Courtyard Ventures, which we raised it from about like MBA students, alumni, and kind of Berkeley people. And that was like a pretty fun experience. You come to the US, you don't really know anyone. And that's like a kind of like a hack to kind of immerse yourself in like venture capital and the network. And, with that a fund that small, you're really like you gotta hustle to get into deals. It's like if you're like we're investing like that at that fund, it was like 25K checks into
Mhm.
pre-seed and seed Berkeley founders. And the pitch there is like, hey, we got like 100 students who all went to Berkeley. We're going to be very helpful to you both on like introducing new investors, introducing people to work for you, introducing you to customers and that kind of stuff. And you go to these founders and you're like, hey, you went to Berkeley, we went to Berkeley, like let's have a bit of fun. But at the same time, no one is gonna like big funds aren't going to be sending you deals because you're like a little tiny thing. So really it's like a hustle. You got to get into the ecosystem, you've got to meet people, and that was actually really amazing. So like, that was all like earlier stage stuff. And now where I'm at Canvas is more like the Series A and Series B. But during that kind of courtyard experience, you met a lot of these earlier stage pre-seed investors. At the time I was kind of sending them all deals. No one really sent me deals, but now it kind of goes the other way around as you get bigger. So which is a nice experience. And so, that out of courtyard we did about 30 investments. And so that was like an amazing way to kind of build this like early stage network, kind of get super involved in the community, meeting entrepreneurs. And like you're actually like putting capital at risk. It's capital from investors. So you've got like a duty to kind of return that capital and make decisions. And so, hey, it's a great experience raising a fund. I don't think you've had a lot of experience here as well. Not many people have actually gone out and raised a fund. So I think that's a great experience. I think it's a great experience being a principal and actually deploying that capital, no matter what the size is, it's still a different mindset. And then, now I have this great network of Berkeley entrepreneurs I've worked with, provided value to, and all of that stuff. So it's been,
Yeah.
and also now you're starting to see some of these companies break out. One company the other day said they're on like, approaching like 10 million ARR from when we invested was like, sub a million. And so these things is like, there's a lot of things growing pretty quickly out there. And that makes it like a, pretty rewarding and fun experience.
I'm reading this book called Thinking in Bets, which lots of VCs mentioned on various podcasts and interviews I read, and I'm like halfway through it. And it's an interesting book that kind of digs into your decision making. And the lens is poker, but it could easily be investing. But do you feel like when you look back at some of your investments, I mean, every time you make an investment, you have to have high conviction, right? But there's this tendency in human nature, and they describe in this book to when things go right, you're like, okay, that was skill, right? And when things go wrong, you're like, ooh, that was bad luck. And they said the best people that learn actually are constantly, and they give this example of, I forget his name, Ivy, one of the famous poker players, and he'll win the whole thing. He'll win like $5 million at the poker table or whatever it is. And he'll be talking at the celebratory dinner with all the decisions that he made and how he could have made better decisions. How do you kind of like keep making better decisions and learning from not only your wins, things that went right, but your losses as an investor?
Reality is, I think in life, like the best thing you can be in life is lucky. So like lucky kind of creates a lot of this stuff. But then the way I think about like what goes behind that luck, because I think luck is something which if you're not lucky, it doesn't matter what you do, you probably won't work out. But it's like, how do you kind of improve your chances that you're going to get lucky? And I kind of view that as like, hey, can I be on the dance floor? As in, like, can I be doing stuff to kind of create an opportunity? Because pretty hard to get lucky sitting in a dark room by yourself because
I being lucky, we're talking about getting a date here, by the way. That's the analogy.
but do you know what I mean? It's like you have this, it's like, how do you create like an opportunity to get that luck? And that is like being out there, talking to people, trying things, which like you might try 100 things and you get lucky in one, but like your odds are probably less likely to be lucky if you try one thing. Oh, it's
Yeah.
that's a spectrum. And so like when you think about how do you, evaluate past success and failure, I think, yeah, you try to be honest with yourself. I think if you can write down your reasons, so it's kind of why you do an investment memo. You write down your reasons of like, why have I invested in this? And like, what needs to go right for this to be a big business?
Mm,
And then you can kind of compare that. And then you probably get all of those things wrong if it becomes a big business, but you can be like, oh, why did I get that wrong?
yeah.
And so I think those are like the discipline of writing something up and being like, hey, this is why I really believe this is going to happen. And then going back and checking that. And I do think these ideas of like going back up to like 6 months and saying like, what is different now from when we invested and what is like changed and like re-underwriting your assumptions. But I agree. I think like if things are successful, it's very easy to attribute that success to your skill. But a lot of the time, things can be out of your control.
Yeah. And that's what the book talks about. It talks about like most people, when things go right, they'll say, hey, that was my skill. And when things go wrong, they'll be like, oh, I had bad luck. And they actually do the opposite with other people. When they see things go right with another person, like, oh, that person's just getting lucky. And when they fail, they're like, that was their skill. And so we have this like kind of double standard. And the best decision makers, and they're starting to analyze it, these various decision makers in the book, they're constantly looking at like, how do I get better at making decisions? And how do I reduce the factor of luck and in those decisions, and then be honest with myself. So one of my favorite activities is I'll go back and I'll review every scrap of material I have on past investments from 2, 3, 4, 5 years ago. Sometimes in some cases I have like call recordings, and obviously I have the memo, and we have all the due diligence and all the notes and all the scores. And I'll just go back for the winners and the losers, and I'll just be like, what did I get right and what did I get wrong here? And I, really kind of dive in. It's really enlightening.
I think the other thing, which let's say if you zoom out of venture and you look at like one of the most successful hedge funds in the world, which is Jim Simons, and there's a fund called the Medallion Fund. If you look at what they do, like his idea was like, hey, you only need to be right you only need to be right like slightly over 50% of the time.
Right.
And then
Yeah.
it's like, how do you keep on refining that and being like, a lot of that's like sizing your bets and all that stuff. But then if you look at
Yeah.
like the returns of the Medallion Fund, which came out of Renaissance Technology, it's like insane.
These are large hedge funds, so you do only have to be right more than half. But in venture, you could only be right, I mean, mathematically, 25% of the time.
You can be right one time.
Yeah.
I think it
One
doesn't matter.
time in your whole career.
But
Yeah.
it's all on the edges. And so like,
Yeah.
so it's all like, how do you kind of create that opportunity to get that edge case? And I think that's iterative as well.
Yeah.
Eventually you only need to be like right one time. And then if that's like a massive win, you look like a rock star. But if you've had like 50 investments and only one is right, is that luck or is that skill?
I've been asking some LPs on the podcast this question, like, hey, like if you looked at my portfolio and I had 100 10xers, and so I had a 10x fund because most of my funds have about 100. Another fund, another GP had 1,000 xer, so it's still a 10x fund, and everything else went to zero. Like, what would you be more prouder to invest? Like, where would you lean? Would you lean with the more consistent GP or the one that hit it out of the park one time? And and most LPs will say I'd rather go with a consistent investor. So that's interesting.
For venture, that's like an easy option though, but it's more like if you were to give that with like a slightly different odds of like you get a X and you 10x you 7x everything, or you've got like a 10x through that X. I wonder what they say because I think LPs just want to get paid. They want to get DPI. They want to get the capital back. But I think venture is, if you understand like the power law, which I think we can go into, is like most funds in venture only return 1x, but then the funds which really return really return. And so I think LPs, you know, I think we can kind of go into like the venture landscape a little bit later in terms of like how, you've got these big venture funds and these small venture funds. But if you're investing kind of in like the more smaller venture funds, you're really looking for the alpha, which is like, the outsized returns, which like, if you kind of if you correlate all venture returns, it's kind of similar to private equity. But it's more, if you look at the dispersion of the returns, it's very much bunched to like a few funds generate a lot of the alpha in venture.
Long tailed,
Exactly.
like a skewed distribution.
Very skewed distribution.
Yeah. Well, let's go back to Courtyard and just kind of finish that story. So you'd gone there. There was a guy named Kevin that had done it before, and so you're kind of the second generation of this Courtyard Ventures thing. How big was the fund? Where did you guys run it? How many investments did you make? All that stuff.
We did about 30 investments out of it, and it was kind of separate to the first generation. So it's just myself and two others, and so we ran that as we're like 100 investors, and just making these like into small investments into Berkeley founded companies, and so that's a massive spread across that, and that is it was a lot of fun because I did it with two friends who two of my best friends from Berkeley. And so it's just like a great way of like working on
Good
stuff.
idea. What year was this at Berkeley?
2022 to 2024.
Wow. Okay, so recent.
So like the fund is still there. We're not like we have to hang around until.
Yeah, you guys are still managing that fund. Yeah.
Exactly.
And how do you hand it off to the next class? Is it kind of like the new class that comes in?
They got to go raise the capital themselves, and so it's like it's separate. It's like, hey, we'll give you advice. Raising capital is pretty painful. I think I spoke to like 300-400 people.
Yeah.
to kind of to do this. And that's like, in a pretty prepared mind. This is like people at Berkeley in your network who kind of understand like,
That care.
yeah, they
Yeah.
care.
Yeah.
And that like the stats out of Berkeley are crazy in terms of like the number of companies which have, you're fishing in a pretty rich pond out of Berkeley. The amount of like Raptor there, the amount of companies which have been huge. You've got, recent years like Databricks, you've got Perplexity, all of you've got these huge companies that come out of Berkeley. So like, you're kind of going to like a prepared mind, but it's still, it's a sales thing. It takes a lot to kind of get people over the line.
So it sounded like there's about 100 LPs. This is a private fund in your private network. So you did a standard kind of raise, a private fund raise, and then you're capped at 99 accredited investors. So it sounds like,
We're just, yeah, slightly below that. So we're below 100, but yeah, within the accredited investor level.
yeah. And then it sounds like it was like a $1.5 million fund, something like that. So about,
Exactly, about 1 million.
oh, you're talking about, 15, 20K checks, just as far as the eye could see.
Checks, and we're doing like 32 deals basically.
Yeah, well, that's on the other side, on the deployment side, but on the fundraising side, typically it was about a 20K check coming in.
Yeah, no, more like 100. Yeah, so more like 10 basically. 10,
Okay, yeah, because all these, they're a bunch of MBA students, right? So they're like, I don't have a bunch of money, but here's 10K.
Exactly.
That's amazing. So, and then walk us through, okay, kind of graduating from Berkeley, you've deployed this capital, which is super cool. I wish I would have done that 10 years ago instead of doing VCIC and just being completely turned off by venture.
Like a lot of this is like incentives. If you do like a course, it's pretty hard. Even a competition. I'm not throwing shade at kind of competitions, but like your incentive is like to win the competition versus to
Yeah.
deploy the
To
money.
do a good job for your LPs. Like there's nothing better than actually doing the job to learn it, right?
Okay.
Yeah, to actually going out and doing the fundraise, deploying the capital. So you go out, you do this huge lift, talking to hundreds of people to raise a little $1 million fund, which I can relate. Our first fund was a little $1 million fund, like literally our little rolling fund for YC companies, and then our second one's much larger. But so I've been there. And then walk us through the founding of Canvas, or how you joined Canvas. What's the origin story there?
Got kind of connected to Canvas like nearly a year ago. So I've been working there for just over a year. Kind of some was like part time, and then now full time. And Canvas is run by a woman called Rebecca Lynn, who's also Berkeley grad. And so, I think what had kind of attracted me to that, yeah, I think what maybe people don't know about venture is, or just actually asset management in general, I'd say, is like each asset management firm is like a very specific entity. It's like it has a specific culture, it has like specific quirks. Like people maybe just think, hey, people are investing money, it's all the same. But actually, each firm is very different. It's like different responsibilities, different number of people working there. And, I think what attracted me to Canvas is like one, the team get on extremely well with the team. It's a very small team. So you get the opportunity to have a lot of agency, a lot of responsibility. It's had a pretty good run. It's been around for a while. So we're on just getting to the end of our third fund. And it's just like, it's a great place to be investing at the Series A and Series B. So Canvas is about 850 million, and we're investing like $5 to $15 million checks basically, typically at the Series A and Series B, with kind of some seed. And then we do a lot in digital health, fintech, and AI. And so what attracted me to Canvas is like one, the team, the stage, and kind of the ability to grow within the platform as well.
Yeah, and you had to be considering doing your own fund. I mean, you've already raised a fund, and you have some track record now. And so, what was that thought process like going into someone else's venture fund versus just doing your own at that point?
I think a lot of venture, to be like really good at it, is like this apprenticeship thing. And like I think the venture investing is like a very specific type of investing, a specific mindset, a specific, a way of thinking about it. And like, an opportunity to learn from the best. Like, Rebecca, she's been on the Midas list a few times. She was an early investor in like Lending Club, Doximity, Case Text, which was sold to Thomson Reuters, and obviously the rest of the team there. So you just got this like amazing opportunity to be part of like a great platform for a long period of time. And again, it's like a small team. There's just four investment professionals on the team. We have like
Including the managing partner.
exactly. So it's a small team, which is great, which means everyone gets a lot of like ability to do stuff. And yeah, it's fun. Do you know what I mean? It's a great place to be, and so really enjoying the time there.
I took a different route. After angel investing for a couple of years, LP in a bunch of funds, I spent a hot minute interviewing at VCs, and I was like, you know what? I think I'll just go do my own thing. and that was Team Ignite for a couple of years, just syndicating, and then the funds. And I kind of, looking back, I made a lot of mistakes that probably could have been avoided if I would have worked for somebody. But that's my path, and I'm sticking to it, I guess. Now, what was the adjustment moving from kind of this really early pre-seed seed stuff to kind of the A and B? What was that adjustment like?
I find the A and B just a lot more interesting, I would say. I think like, the pre-seed and seed is fun, really, really fun, but it is just like it's just like so much to people. And I think at the Series A and Series B, you've got a lot more, you've got some data. You can also talk to customers. And I think, one of the things at Canvas we spend a lot of time doing is talking to customers. It's like, what is the customer, how are they using the product? How is the company adjusting to how, like, understanding, their problems and working through that. And I think the customer is pretty key in terms of like understanding that. And so the A and the B, you're early, but you've got something. Like the pre-seed and seed is very fun, but it's like is it financial investing? Not sure. You're more investing on like the story, and I think my kind of more like rooted financial background. I like the numbers and the metrics, but I also like the kind of people aspect as well.
Yeah, the percentage of data and just call it analysis kind of shifts to a much larger proportion in the A. From pre-seed, it's like mostly just team, maybe a little traction. Seed, a little bit more traction, a little more stuff you can kind of sink your teeth into. And then A, like that pendulum's now kind of like much more about the business and the market and the customers.
And do you know what? And I think in one, which I think it's all a balance, but I think at the moment, one thing I'd say, like, it feels that it is a great time to be a founder of a pre-seed and seed company with like very little traction,
Okay.
like a very,
Yeah.
very good valuation. Where like, at the Series A and the Series B, you've got to now, it's at a stage where you need traction. And so like, I think that gap between like the seed and the Series A is not just like a valuation gap. It's like a massive de-risking. And like
Yeah.
you've seen a lot of the execution, you've seen a lot of like how are they filling that, how are they doing, how are they dealing with the problem. And so like I think the seed and B, you've still got that like venture capital, like exit potential and multiple potential, which you probably don't get now at like the Series D. People at the Series D is like D to F is more like pre-IPO investing now. A lot of everything is kind of
Late
figured
stand.
out.
Yeah.
Yeah, where like the A and the B, you're early enough that you've got that like potential for venture return, but you're kind of de-risk a little bit more from the seed and the pre-seed. And so like, amazing time to be raising capital as a founder, I think, of a pre-seed or seed company, because with a great story, great reputation, you can raise, very, very well-priced rounds.
I see a lot of 10, 15 caps with 100, 200K of revenue, which is very favorable for pre-seed seed versus, like my favorite rounds are like, hey, I have 1 million of ARR. I'm not quite ready to raise an A, and I'm raising, at a 10 to 15 with 1 million of ARR. That's like
Yeah.
right down the middle of the lane for
That's
us.
a lot, because I think like
Yeah.
as soon as you start getting revenue, people start discounting that revenue, and so like you can just pure story, you can get a great valuation.
Do you think pre-seed is always pre-revenue? Because I get into arguments with founders on this, not arguments, but discussions. They're like, well, wait, I thought you were a pre-seed investor. I'm like, yeah, but I don't invest in like ideas on decks.
I think it's
Like,
like
how do you think about that?
I just think it's semantics. I think
Yeah.
at the end of the day, it's like capital into a business which you believe in. Like obviously, as long as it's within the range, like probably for like where you are, it's probably more valuation sensitive, I'd say, than being like it's like, hey, if the pre-seed is like 50 million, you're probably not going to do it. But if it's like a company with like 2 million run rate and it's like a 15 million cap, you can probably do it.
To get in the way, but if it's ridiculous, yeah, I mean, maybe. Some of the more expensive deals I do are like Y Combinator deals, right? Where they have barely any revenue and they're 20 caps. But I've gotten a lot of ton of great markups there. And conversely, I've been in lots of 4 and 5 cap companies that have gone nowhere. So I don't think there are any hard and fast rules about entry points. It's just you kind of have to feel it out, I think, and kind of every startup's a snowflake. That's what I like to say.
You just
So you
want to
just kind of
back the best founders, building
yeah.
their faces, and like really getting stuff done.
Another thing I've heard about A and B rounds is they get a little bit more sharp elbowed with competing term sheets, especially for the best founders. How do you guys kind of, stay competitive and win those rounds?
So I think like, what I like to kind of tell people is, let's say Canvas, we're not trying to do that many deals. So out of this latest fund, which is 350 million, we're doing just over 20 deals. And so, we really have to, we only do a few deals a year. And so we really have to believe in the company. We're not going to back like three competitors. Like some of these like very large funds, it's like a different strategy where they're doing, they need to be in every single big company. And so we're going to be like, hey, we're really going to spend time with you. We want to take a board seat. We want to really like help you grow. We're also going to be there for you when things are going wrong. We're not going to kind of like step away from the business or when it's hard times. We're going to be with you for like the hard decisions. And then also it's like, hey, we're going to try and provide value to you like from the go point. And that could be pre like getting to the term sheet. It's like how, we've been in processes where we've like, been lower term sheet because we've just provided a lot of value throughout that. And then I think four is like, go to the founder. It's like, go do your due diligence, talk to our entrepreneurs, talk to the people we work with, and like really understand like, because like at the end of the day, I think some people get confused and they're like, hey, I want to work with the brand. But at the end of the day, it's the people what you're working with at the platform. And so I think really the key is like, selling it on the people, selling it that like we're a pretty collaborative team. So it's not like, hey, one person's doing a deal, no one, they're going to kind of be quiet about it. No one's going to talk about it. It's like, hey, if there's something wrong or there's something which needs to be done, or like it's like something, everything's going well. They're like, how can we make it go better? Everyone's kind of working together to kind of help that, how the business going. Yeah. So I think those are kind of the pitches I give to the founders.
So it sounds like, okay, on a $350 million fund, you're kind of doing about 50% of it first checks then, and then 50% follow on.
Yeah,
Is that
exactly.
right?
It's kind of around that, like roughly, like slightly more, probably like maybe like 2/3 first checks, and then like a
Okay.
third, or kind of that, maybe a little bit towards that.
Okay, interesting. And so how do you guys think about the follow-on strategy? You invest at the A, you lead, you take a board seat, and you're doing 20 of these, let's call it, and you can't invest in all 20 in the Series B. So how do you guys think about follow-ons in the B and the C and the D, and like how much you follow on, all that stuff?
Will be like there'll be a lot of discussions around like the reserve requirements, and then and it will depend. It's like how has the business performed versus what we thought it was going to do. Like, and sometimes the rounds just get too big. Do you know what I mean? Like, should we be following on in like a multi-billion-dollar round? No, because it's like
Yeah.
it's not gonna cause like. And so I think everything is like a case by case. It's like, what, like, do we think this is like overvalued the business versus where it is now? Do we really like re-underwrite the business to be like, okay, how's everything proceeded, what's happened, and all that stuff. So I think everything is kind of a case, like, the intention is always to follow on, but it's always like it'll just depend on how things are going.
What about exit strategy? I know you're kind of early at the firm, but as you kind of look down the line, and these things do get overvalued in venture a lot. We kind of go through these like mini little booms and bubbles. You're sitting on a position that you invested, you're 5 at 30 or 5 at 50 or whatever it is. And now it's gone, it's a fund returner, right? It's gone 20, 40, 50x. So you've 2x the fund on one deal. How do you think about trimming positions? Do you stay all the way to the end, all the way to an acquisition or exit, or?
Again, massively depend on the market timing, but I do think in terms of like preparing businesses for exits, I think we definitely believe that like as a CEO, you should be talking to all the people who can acquire you all the time. Not because they can acquire you now, but like be one, it's because like you're in a specific ecosystem. It's great to know people in that ecosystem. It will probably help you build business. And like, and then if something does happen, you kind of got prepared minds for things to kind of jump on. And maybe it doesn't work. Maybe you just get like an offer from out of nowhere, and the business can get exited. But I think if you really know, and so like then what happens, you can kind of spin people up pretty quickly. A business gets an offer, you can then go to like the three people you've been talking to like intermittently for the last few years and be like, hey, this is happening. And that can really create that like competitive tension to kind of drive prices up. And so like I think we think a lot about what is the exit. Not all, if you look at the IPO market, there haven't been that many IPOs. You need to be bigger and bigger to be IPOs. So a typical exit now is more like an M&A transaction. And so you've always got to be thinking like, where can that come from? How do I prepare for that? And what's the kind of best way to do that?
Looking back at the history of the funds, and I know you're not the founder there, but do you recall how big funds 1 and 2 were, and how the strategy might have shifted over the funds?
So I think fund one, I think was 175, and then 250, and then kind of 350. And I think
All roughly the same size,
all kind of roughly the same size. And I think, what I think the strategy is now shifting a little bit more focused on um, digital health and fintech. So and also AI. So like the last deals we've done have all been that. And so like, I think we've realized that a lot of the biggest returners have been in those categories, and those categories are huge. And so I think it's like fintech, digital health, AI. with an overlay of Berkeley. We've actually had a lot of big Berkeley winners. Casetext, which was sold to Thomson Reuters for 650 million, was like a Berkeley co-founder. And so the last investment we did, a company called Savvy Wealth, was also Berkeley co-founder. And so like we realized that there is a good parallel there. I'm fairly connected in that ecosystem as well. So that's like a great place to be. And then we've done a lot in fintech and digital health and AI over the time, where like Canvas spun out of a firm called Morgan Thaler, and they were like an early investor in Siri. So like, pretty far back on the kind of AI train. And so I think what we realized is like those areas we've done pretty well in the past. We've got super deep networks there, so we can really help companies with customer introductions, really understand like the problems these companies face and areas in which we can help improve them. So that like, I think we're doubling down in those spaces as much as possible, because I think that's like 40% of the economy, basically, right? Whatever the number is, it's like a huge percentage. Healthcare and financial services. So
Yeah, and financial services. Yeah.
like those two together, I think, healthcare is like 20%, but then just on when you add on financial services as well, it kind of touches everything.
This episode of the Ignite podcast is brought to you by our friends at Build, spelled BYLDD. Build is a development agency that specializes in helping early stage startups, especially non-technical founders and teams, build and launch scalable revenue generating software products. Most startups don't have $100K to hand over to a big agency, and honestly, for your first product, you probably shouldn't. Sure, you could try rolling the dice on some freelancers, but that's a gamble with unclear costs and a lot of project management headaches and no guarantees. That's where Build comes in. For just $10K in about a month, Build can turn your validated idea into a real product that's ready to go to market. It's a smart, efficient way to build a foundation for a company of any size. And yes, companies that start with Build can and have scaled very large. Their clients have gone on to be backed by YC, Y Combinator, and Google, and raise funding at multi-million-dollar valuations. Ready to get started? Head over to build.com. Again, that's BYLDD, to connect Ayush and the team and let him know you heard about Build on the Ignite podcast.
Yeah, that's interesting. So we have a ton of overlap, and you probably see our deal flow because I'm sure you're on the deal flow list. But how do you think about investing? Let's just take them one by one. I'd love to talk about health tech, fintech, and AI, but let's just start with health tech. We've done some stuff there. It's a pretty complex area, right? With some big incumbents like Epic and stuff like that. How do you, when you look at something, what are you kind of looking for in health tech that you lean forward and get excited on?
So I think, a lot of life is about incentives, and like, the healthcare system has some incentives which can be hard to understand on the face of it. And so like really you need to understand like what is the incentive within this particular paradigm for each party. And then it's like, how does the company we are investing in interact with all these incentives, and what happens within that? And I think that's why healthcare is complex as like an investing space, because you've really got to understand that. And I think you also want to be as close to like the decision maker of who's making the payment as possible, because I think if you're far away from that, it can just be painful to get paid, or it can be like a long-winded sales process, or all of that. And I think in healthcare at the moment, we're spending a lot of time in things like revenue cycle management, ways in which payers, providers, and all that kind of interact and how they get paid. We also think that there's definitely like an administrative burden in healthcare. And so different ways AI can kind of tackle that and bring down that cost, I think it is interesting. And so like, I think that's why healthcare is like a particularly fascinating place to invest, because it's pretty complex. It's pretty like messy in terms of different things, but then I think there's like a huge ways in which it can be improved. And I think there's definitely this catalyst of, one, administration, B, like less and less people want to work in healthcare. There's a lot of burnout. A business we're invested in called Marvin Behavioral Health, they're doing like therapy as a benefit to physicians and doctors in healthcare systems, and they're seeing like amazing results in reducing burnout for these people. And that's pretty expensive for a hospital, because if someone churns out of the hospital, it's like a few $100,000 to recruit someone, train them up. And so I think there are all these shifts in the one is like more at home like therapies and all of that, more
Remote-based therapy, AI
it's
video
more
detection.
home care. So we invested in some companies which are like facilitating that. A company called Float Health, which does like at home like IV treatments in terms of transfusions. So they're helping like connect nurses to go and do at home transfusions, because a lot of people don't get transfusions because nurses are churning or not turning up. And so I think there's like a lot of like secular trends in healthcare, which are pretty interesting to invest in at the moment.
Nice. Yeah, we invested in one called Fiction Health that uses AI for dermatology. They go direct to consumer. They actually employ dermatologists, but they're 4 or 5x more efficient. And so the margins, AI is kind of eating professional services, including healthcare, right? It's making professional services businesses like healthcare higher margin.
Yeah, I think that's what's like, pretty interesting AI is if you think about a professional service business, you've got all these different like cogs, which are like a lot of it's people, a lot of it's like working on different things. And I think you can kind of break down like each of those cogs and think like, how is AI going to help in this thing? One is like marketing. Can AI lower the cost of marketing? Or two, can like AI lower the cost of the administration? And so like each of these can kind of be broken out. And like, as you say, that can really help a services business where most of the costs are people, where if you
Yeah.
can like supercharge the people. And I think, what we see is a lot of these AI tools are not reducing the number of people. They're just enabling businesses to grow more and not hire additional, I swear, we do a lot of customer calls and I've never heard someone be like, not never, but I never, we never, like basically never hear people be like, hey, we're using the AI to reduce people and headcount. It's more the AI is enabling us to like grow to a
Do more.
bigger
Yeah.
size
Yeah.
with less people. People, it's again, it's like if it's like a high churn business, it's like it's very hard and expensive to retrain and get more people on.
Yeah, totally. What about fintech? What do you see going on there that you're excited, makes you lean in?
So fintech, we've been spending a lot of time. Well, I think the last deal we did is this company Savvy Wealth, which is in the wealth management space, which we got, pretty excited. We're like extremely excited about like wealth management, and so I can kind of double tap on that one in terms of like why we invested in that. And so Savvy Wealth is like it's a technology company which is also like a full stack RIA, which is a registered investment advisor. And so what they do is there are these, you'll have like wealth managers will then manage the wealth of like high net worth or individuals. So you'll have like one wealth manager, let's say they have like 100 million they're managing, that could be like 100 individuals underneath them who like kind of giving them their money to invest. And these people are working, like big firms like LPL, Charles Schwab, all these like bigger named like RIAs. Savvy did is they built a whole new tech stack which is just way more efficient for these RIAs, for the managers. So like, a lot of the industry is pretty antiquated technology. And so Savvy are really focused on like giving back time to the managers. And so they attract managers from these other platforms to kind of bring their books of business and they just give them like a much better experience. They give them ways in which like they can automate their workflows, they can better deliver value to their clients. And
It's a vertical SaaS product for wealth managers, basically.
yeah,
Yeah.
exactly. And so like they, the way they charge is more around like what the fees are. Like people will charge on like an AUM. And then also the founder there, a guy called Ritik, he again went to Berkeley. This is his third business. He sold one business to Box. He sold another business to Brex, and then he launched Brex Cash, which became a pretty big business line within Brex. And so he's like a third-time founder, like extremely experienced, and you can kind of tell that in the way he runs the business. And so, during that, we spoke to a lot of advisors, and really, like, it kind of came through how much the team like listens to feedback, delivers products which people need, and it was like, and they're building the whole solution themselves. They're not using like point solutions or most of the solution themselves. They're not using it like as they need to, and they're not using like a lot of these point solutions which some of these other kind of newer players do. And so that is like, that business is doing extremely well. They became like, I think we think either the fastest or one of the fastest RIAs to get to $1 billion in asset management, like assets under management. And it's just like an amazing experience that they're delivering for their advisors. And wealth management is just like a ginormous space where there's also this huge change of the kind of the guard of like the biggest transfer of wealth in history, which is about like it talks of like 68 trillion kind of getting moved. You've also got this idea of like, I think COVID can be viewed as a catalyst where like suddenly you need things like, not like a lot of these places will be doing like wet signatures to join the firm. And so like all of these things where you can like, and if you're like a manager of like $100 million, you don't want to be chasing someone for like a wet signature.
And you don't want to be looking at like a dozen different platforms to try to figure it all out. Like if it's a turnkey kind of SaaS solution, this is what I love about vertical SaaS. There's lots of billion-dollar companies you've never heard of building in vertical SaaS that nobody's ever heard of. Just like this one, right? Like I didn't know of this one, and I invest in fintech, and there's lots of billion-dollar companies like that just execute really well on this pretty large swath of the market.
Exactly. And I think, this is also like you've got the technology side, but there's also the human side where like, there was this wave of like robo advisors where everyone thought you would never have a human.
Yeah, the wealth
I,
fronts and the
yeah,
yeah, yeah.
which I think Wealthfront's kind of having a bit of a moment at in terms of with interest rates, they're starting to do well again. But like, I think typically people want to know, they want to be able to pick up the phone and be like, "Hey, Brian, like, what should I do with my mortgage? How are the markets today?" And so, like, I think giving people the technology to enable them to deliver that core part of their job is like an amazing, amazing, amazing business.
And let's last but not least, let's talk about AI. Do you view AI as a category, or do you view it as like an enabler of other categories? And do you invest in like kind of AI as the category, or you kind of
I think about AI is kind of like a tsunami shift of like everything has to become AI, or become like AI enabled or AI this. And I think, I kind of think about it from like the first assumption is like, I just think intelligence is getting cheaper and cheaper. And so, obviously there was like this DeepSeek moment where like everyone was like, wow, but even before DeepSeek, ChatGPT had lowered their prices like 90% and delivered like a 10x better product. So I think there's an idea of like, intelligence is just getting cheaper and cheaper. So you should really be building for the future, which is coming pretty quickly. I think, AI is also enabling new like ability to kind of tackle like a smaller TAM. And what do I mean by that is like kind of what you're saying there, like AI has lowered the cost so much. Like, we're on a podcast now. This is not AI, this is technology, but like think how much this would have cost like 10 years ago. And then think about that to like the nth degree with AI where there's now an ability for a business to kind of go after a much smaller TAM that might not have been achievable, before. And so, that's kind of this idea of like, maybe there's a lot of niche markets which are now opened up in, fintech and digital health, which are now viable for a venture scale business. Because if you can build if you can build 100 million business plus with like amazing net margins, that can be like a huge business. I think that's pretty interesting. I think definitely these like idea of like an AI native business where you're like outsourcing and abstracting like anything which is not core to your competency. Whether that's go to market, whether that's, phone calls or customer service, training, scheduling, like so much of this can be given to other AI companies. And then you can have these like, I like this idea of a Velociraptor, which is like very small teams with like a very big ARR or revenue per employee. So like plus 50 million revenue or with kind of like less than 20 employees.
yeah, it's a new kind of unicorn.
So yeah, it's a different kind. I think that's like a different thing of
Who
like
coined that? Did you guys coin that?
I've coined it. I'm trying to push it. That's what I.
Velociraptors. I love it.
I think it's key. I think it's key.
We need an exact definition. So it's okay. So unicorn's a billion private.
Yeah.
A
I'm
Velociraptors.
saying 100 million ARR with less than 50 employees is how I'll define it.
I think it's even more. I think it's like 20 employees.
I think like it like at the end of the day, it doesn't matter 20 to 50. Do you know what I mean? It's
Yeah.
like it's more like, hey, this is that the mindset is not about raising these massive venture rounds and not about having like 10,000 employees or like
Well, I think we're seeing that. So like, how do you feel about that dynamic? And I'm definitely seeing it as an early stage investor where I can run across bootstrap teams that are raising their first round with $1 million of ARR, and there's 2 or 3 founders, right? And so, and I'm seeing lots of founders get to 10 million with 8 or 9 employees. And so,
I think it's like I think we're early in this wave, and I think it's like and if you look at like some of these companies, I think like Mid Journey is like 20 million of revenue per employee. They're like a 200 million run rate. That's obviously the outlier, but I think you're going to see this more and more where like people are using all these tools which are just getting better. Like, and part of the reason this works is like Microsoft are talking about like all these companies are talking about like 120 billion this year of infrastructure investment, and so like all of this infrastructure just creates this like massive like free leverage for like small people teams where like it's not like hey, these teams are doing it way more efficiently. It's like no, they're just leveraging all the tools which like everyone else is investing for them. And so I think more and more you're going to see these kind of velociraptors in the wild where I think what does that mean for these businesses? I think is the other question. I think the good thing you can argue is like efficiency, fast growth, but like the kind of counter side is like what is defensible about these businesses and like how do these businesses they're able to grow so quickly with such small teams, and like will the early employees of those businesses like realize what's possible? Will they then go and build their own velociraptors and kind of come off the original? And like as the tools get better and like if I'm building a business in like 2 years and all of the models and all the AI advancements have happened, I can start like a much like more advanced business. And so like I think a lot of these businesses are going to have to focus on like what is that durability of revenue. I think AI has created this like massive catalyst of everyone wants to try stuff, and like these tools are creating massive value. So it's amazing they can grow the revenue, but the question is like, is it kind of a sugar revenue, or is there like long-term durability to the revenue? I think that remains to be seen. And I think, a lot of these like super fast growing companies are very horizontal. And then it's like, will these kind of more verticalized, specialized companies kind of come up and build something great as well? And obviously there's a lot of great vertical companies out there as well, but it's a pretty fun time to be out there.
It's an interesting question. I think we're in a lot better place than we were in the dot-com boom, where it was all just like users logging on a website or visiting a website, and not a lot of revenue and just a lot of losses. And now, to your point, it's, these startups are more capital efficient than ever. They could scale with less and less capital. How do you feel about that? I mean, you're still an early stage investor at the A and B. If you're sitting at the C and D and E, are you looking at this like coming down and you're like, oh crap, are we going to be able to deploy enough capital here?
Well, I think that's like a broader question of like the bifurcation of venture in general, where you've got these like very large funds which have to deploy large amounts of capital. And then you've kind of got like the smaller, like sub $500 million funds. And so, I think it's just like a different return profile you probably need to be thinking. And I don't think there's not like, I'm not like being like one's better than the other. I think it's just a different mentality of investing. I think if you're like $1 billion fund, you have to, and like the numbers are there. Like the bigger funds deploy more capital per deal because they have to, because they need to be in everything. And so
Check size is 25 million, no matter what, like, because we have to deploy it. And it's hard to deploy $1 billion.
but then if you look at like to deploy $1 billion and then to return like 3 to 4 billion, which is kind of what these bigger funds have to do, but you've got to be in like every single breakout deal. And so I think these are more like ETFs maybe, or like you're delivering like, I definitely, these big funds can deliver alpha, but it's delivering like alpha versus that base, where I think like the smaller funds is more like, hey, you're more in that kind of like pure venture, like power law returns, where like people are investing in that to, this idea of like, are you in the market for like the management fee or for like the carry? And I think the smaller funds, it's just like a lot, like just like mathematically, without anything else, it's a lot easier to 3x 200 million than to 3x like 3 billion.
Right. The joke I tell my LPs is like, you got the alpha orangutans in the jungle and they have to control the harem, right? They have to control the whole tribe. But I'm like the beta orangutan and I run around the jungle and I sneak up.
Both of these are like, both are like valid strategies, and it's great that LPs can choose between the two. And I think it's like investing in like the foundational models is more of like a big fund strategy, because you need a lot of capital, and it's expensive. And so like that's why I think we're a lot more focused on kind of the application layer.
Yeah, you're kind of somewhere in the middle. You're not a small fund, but you're not a huge fund, but you're big enough to be relevant and lead. It's a good place to be. I think we'll probably terminate at about a $250 million fund in the long term for Team Ignite. I don't think we'll get much larger. We'll stay the high volume strategy without board seats. I don't see going concentrated. So we'll have 2, 3, 400 investments per fund, which sounds crazy, but that's kind of our style. So, but it's good for you guys because you'll have a lot of deal flow from us. Do you guys invest globally?
No, we're mainly US, or like we got some stuff in Canada. So like I think, and again, that's just part of the strategy of like concentrated spending time with companies, and like, never say never, but it's like very much, it could be a company which is building like somewhere else, but it's moving to the US because they've got a lot of customers in the US and that kind of stuff.
Right.
But I think, the
Got to be a US focus.
Yeah, I'd say mainly the North American focus. There's just so much going on here, so much opportunity. And like, I think San Francisco feels like it's ground zero for AI. Feels like a lot is happening here. Feels like the city, even when I got here a few years ago, it feels the city's really changed and got better in terms of like moving back to maybe where it was a few years ago. So excited to be here as well.
Yeah. Well, why don't we wrap up with a rapidish fire?
Sure.
I call it rapidish because we end up just talking a lot. What's a founder quality that immediately signals a best to you?
I think resilience is pretty interesting. Is like, what's kind of gone wrong and how they've reacted. But I think probably the most important is just like instill clock speed of like how fast they're iterating and how fast they're learning, how fast they're moving. Because I think especially in this world of like AI, like you just like everything is changing so quickly. So I think you just got to be open to like the fact that like what you thought yesterday is maybe different to what you think today, and like how do you kind of react to that?
How do you measure that? I mean, you're probably, because you're talking to these founders for many, many months to write these large checks, you're kind of seeing it over time.
Yeah, exactly. So I think a lot of the kind of best stuff, best deals we've done has been like where we've, either not invested at the A or the seed, or like we've just known the founder for a very long time. So we can like help introduce them to like people in our portfolio as potential customers. And then you can kind of see like how they're reacting, how they're changing. And it's just amazing to see like, if you talk to someone and then a year later, does the world look very different to how they thought, or like has what they said happened and have they delivered on that? And I think if someone's like, hey, this is going to happen, this is where I'm focused, and then they kind of get it right, you're like, oh, wow, that's pretty impressive. Because I think to do that is very hard. And so it's pretty impressive when people do what they say they're going to do.
What's a favorite Berkeley startup you didn't invest in but admire?
I think a company like Perplexity, where, in a way that company should have like no right to exist because it's like fighting against Google. It's like, it's in like it's such a hard market. They're just sitting on top of models. But like, I think that team,
ChatGPT can surf the web too. So now it's hiding, yeah.
but like that team just is, if you talk about clock speed, every time, like every day, they're coming up like a new product. And so I think they're just setting, they're setting the speed of execution. People love the product. And so I think they've done like an amazing job. And that was probably like, I think if I'd been at Berkeley a year earlier, that might have come across already. I think by the time we were there, it was like $1 billion valuation.
Oh yeah.
Well, like,
Yeah, I missed that one too.
probably not one we missed, but it would have been like a pretty cool one because I think, they're fighting against it's like, what's it called? The David and Goliath story. And they seem to be doing, it's still pretty small, like in comparison to anything, but like they just really seem to be executing well. And I think that shows the strength of the team.
Yeah. What's a book or resource you recommend for aspiring VCs?
I think it's like, I was a history major. And so I really like to understand like why something's happened. So I think there's a great one called The Power Law, Venture Capital and the Art of Disruption. And that kind of like talks about, it's a guy, Sebastian Malaby, and that kind of talks about like, why is Silicon Valley big? Why is like it? And it's like amazing stuff where like,
Really good stories in that book.
Yeah,
Yeah.
so- and-
I listened to it. It was great.
Boston got a lot of money from the Defense Department as well. And it's like, why didn't, but obviously Boston's a great tech hub, but like, why is it not the same level? And I think, and it kind of dissects things like, things like non-competes not being valid in California, and like going into the history of like how and why. And a lot of this is like the network effect of if someone has a big exit and then they can now afford to put like 500K into Google, and and then also it's like, you get these exits, you get these early employees. They like I think in a lot of places don't like with like equity in businesses, like it's less valuable because people haven't seen like the potential of what it's worth. And I think, one thing in Silicon Valley, everyone's after equity because they've seen their friends or whatever have like big exits. And so like, and I think when you're kind of fighting for equity, you're really like willing to kind of do stuff outside of the box versus if you're just going for like a base salary.
Yeah. Yeah, lots of good lessons in that book. What's the biggest misconception people have about working in venture capital?
I think everyone thinks it's like a super glamorous job. And obviously like it's more, it's like a lot of like talking to people, letting people down, not investing for a specific reason. And so like, you just got to be very like curious.
Saying no 99.5% of the time.
And no,
Yeah.
because it's not, because it's like there's so many reasons to say no, and it's so hard to say yes that and like I think it's like and then you're talking to the founders where this is like their life work, and so it's like you've got to manage those expectations. And I think you just
It's like telling you have an ugly family. Your baby's completely ugly, and
Exactly.
like it's like, oh, it's painful.
and
And then founders will push
yeah.
back. They'll push back and be super rude over emails or like calls and stuff.
So I
know,
always
you
try
don't
to
get
like
it.
I always try to say like why we've passed, and I know you can kind of get pushback, and I think some people will just like not will like ghost people, but I'm always like, hey, treat people how you want to be treated. Get back to people, give them a reason why, and just be honest about it. I think there's always, and like whether the reason even sounds like, you just got to be honest about why it's not going to work out. And I think that's maybe I think people probably just think venture capital, you're sitting there and writing checks, and it's not all that.
I think you nailed it. People think it's glamorous, but it's basically like any other job, like except you're meeting even more people and sending even more email.
Exactly.
So I feel like I'm just right back at Microsoft, just looking at decks, attending meetings, and sending email. It's like the same stuff, but it's more interesting. I think it's intellectually stimulating for me personally, more so than than diving deep and building stuff. That's just me personally. Some people would prefer to dive deep and spend years or decades of their life building one thing or in one area, but it's not for everybody. So don't, Grass is always greener, right? Do you have a go-to productivity tool or app?
I think Granola, I don't know if you use that one, is
No, what is it?
pretty amazing. It's a note-taking app which kind of sits on your, it's got like an SDK which sits on your desktop, and it just does like the time to value with that app is like very low. You can just put it in if you got like back-to-back meetings, and it will help with notes. You can kind of like put your own thoughts in, and it edits them, and it's really, really well done as like a note. Granola, like kind of like the food.
Granola, like the cereal or the.
Granola AI. So I think they've done an amazing job of like just creating a product which works. I think there's a lot of these note-taking apps out there, and these guys just have a product which works extremely well and is like very valuable.
Oh. So it like kind of listens on your Zoom calls, it
It's
like
not-
look at your emails and what you're like looking at and stuff like that.
And it's not like it's not recording, it's transcribing. So it's not like you can't go back and like watch the video and all of that. It's more just like, hey, these are, and then you can kind of tell
It's
it
just kind of capturing, it's
exactly,
basically taking stills and digesting it and synthesizing it and
exactly
keeping
just
track of.
what the key points were, and then you can kind of like tell it to write notes in a specific way. And I think it's a pretty useful tool.
That's interesting. And you're using that.
Yeah, it's a
Okay.
great thing to use.
That's cool. If you could solve one global issue through tech, what would it be?
So I think like the they do like selfishly, I saw this like Sonic Boom company the other day, and I was like, wow, like I'm originally from the UK, my wife's from Portugal, so a lot of family and friends are in Europe, and if you could get to Europe a lot quicker, it would be pretty nice. That I can't remember the company it's called. I mean, and so that would be like the more selfish one, but I think I like in terms of general, I think there's like a lot of like bureaucracy and like administration which blocks people like starting companies or whatever it is. And I think like that kind of like administrative bloat is like it's kind of pointless. And I know a lot of it's probably put in place for like good-hearted reason, but I think there should be like it should be very just easy for someone to do something if they want to, versus like get bogged down in all that stuff. And I think in the US it's pretty easy, but I think across the world there can be, different stuff. Like I was a director of a company in Hungary, and like there you've got to do like notarizations of all documents and all of that stuff.
Oh yeah.
So there's like, it can be pretty painful. I did a deal in like Germany, and you've got to do again, let's like signing documents with like a notary to get things done. And then, it's all expensive and like time consuming, and that I think just kind of blocks out a lot of innovation.
What's the best piece of advice you've received in your career?
I think it's just doing like something very simple, which is like do what you say you're going to do. And I think 99% of people probably don't do, which is like if you say you're going to follow up, follow up. If you say you're going to do something, just do it. So I think that kind of comes into the idea of like
Or say you can't do it and you'll get to it.
exactly and like don't not like hide, not be like because I think a lot of people will be like, oh, I couldn't do that, so I'm just going to keep quiet and hope they forget. And so I think like do what you say you're going to do and be like, all right, sorry, I couldn't do this for whatever reason. So I think that is like a key thing of like just it's like a very simple thing, but I think that like puts you in a pretty good place.
Yeah. Yeah, I love that. And then tell us about the newsletter built by Berkeley. We didn't get a chance to talk about it, but I saw it in the show notes. And when did you start it? That's still going? And
Yeah, so that's like quite a fun project slash labor of love. So I started that last year, and I was just like, hey, the Berkeley ecosystem is amazing. Because Berkeley's a public school, there's probably less like money going to like helping connect different parts of the ecosystem. And so I was just like, okay, every week my like belief was that a lot of companies from Berkeley, founded by Berkeley people, will go out and raise capital. And so I was like, okay, I'm gonna like, and firstly what I did is I went and told people, I was like, I'm gonna do a newsletter which just announces every week Berkeley founded companies. And that way I was like, eventually I was like forced to do it because I told enough people that I was gonna do it. And then it's just like basically every week it simply just says like the amount, like what companies raised, how much they raised, and kind of like who invested. And then I kind of put like a little blog on top of like my kind of general thoughts. And you know what? It's amazing, like the amount of capital raised in terms of like, I started in like June, and it was something like I started in July, and between July and December, nearly 27 billion was raised by Berkeley founded, like 1 billion a week. And, I think a lot of people, the newsletter's got quite a lot of viewers now, quite a lot of readers, Berkeley investors and all of that stuff. And so, I think people just didn't even really realize like the scale of like what's been happening in terms of innovation at Berkeley. And I think, especially because I think I would say the archetypical Berkeley founder is maybe slightly older. I think, out of like a Stanford or something, a lot of people will like kind of spin out straight away and go and start a company, but I think Berkeley, well, I guess we're getting a hunch here versus I would say people will go and work somewhere for a little bit. And I think part of that is like, the kind of profile of people is probably skews like a little bit less affluent. And so people are like, hey, I want to go and like build something like a bedrock and then maybe go launch something. And so the newsletter, I think, is just a way to like kind of like keep people who read it that like there's a lot of stuff happening, there's a lot of innovation. So that's been pretty rewarding. And it's also created like a lot of, amazing things where like a lot of people reach out to kind of chat through that. So it's been a great thing. So everyone should follow that, even if you don't.
Yeah, very cool. Well, thanks for joining us and sharing all your journey and insights. Where can, besides the newsletter, where can folks find you online?
I think just drop me an email. Is zan@canvas.vc, or
Man,
just kind of chat
you're
to
so
me.
brave putting your email out there. That's crazy.
I'm always willing to chat to companies. Please don't send me sales pitches.
I get like 50 cold emails a day. I'm gonna have to switch my email address pretty soon.
Exactly, it's tough, and especially now. I guess we could have a whole nother thing on like what happens in go to market when like everyone can write the perfect AI email. Like email just becomes devalued.
Well, I had a startup hyperbound that pivoted away from this. Actually, he was on episode 2, and then he came back at like episode 40 and talked about the pivot to more like sales training. And what they realized in the data is they could use AI to craft a perfect pitch, perfect email, but it didn't change the outcome. It didn't change how many meetings were booked. It just changed the response rate. And so there was no value actually created in the cold outreach, because people are either like they either want to buy your product or not, right? Just because like you have the perfect email, that just means they're just going to respond more, but that doesn't mean they want to buy it. And that's what they realized in their data, and they're just really smart guys from out of YC, and so they just pivoted away from it. Not to say that won't work. Everyone needs outreach, but I think what's even more important is targeting. And I have another startup that does that called Vector.
We're actually an investor in Hyperbound as well with Courtyard, so it's good to be part of that one with you.
Oh, nice. Cool. You guys did the seed out of YC as well, or?
Okay.
Okay, nice. Yeah. So you know about the pivot and stuff. And yeah, just Tool's an amazing guy. Been on the podcast a couple times, but we have another one called Vector, and that's what they do. They crawl the internet and your LinkedIn profiles and everything, and they try to figure out, based on your ICP, who is most likely to buy your product. And that's really the problem. It's the targeting. It's not like, oh, it's over 1,000 people with this and that. No. It's like, does somebody in that organization have that hair on fire problem right now and will actually buy your product? So I think that's even more important than cold outreach.
Yeah, I think timing of outreach is like the most important thing.
Yeah, totally. And I think to your point, we need agents to respond to emails. Like, and so I've been looking at that. I actually evaluated one from YC, and it wasn't quite there yet, but pretty soon I can imagine just this agent crawling my emails and just identifying like, hey, is this a cold outreach? They're pitching for money. Okay, send them here, send them to the form. Like, oh, is this an intro from a founder in your database? Hey, you should probably look at this a little more carefully, stuff like that.
It's just agents on agents, I think, and then you don't even need the crawler. Like API to API.
Agents it's agents, it's turtles all the way down. It's agents all the way down throughout the entire universe. It proliferates and turns the entire universe into agents talking to agents.
Exactly. That's what people hope.
Assumes all matter and all light. The light cone of agents is emanating from Earth right now.
Exactly.
Well, thanks so much for coming on. Awesome
Thanks,
conversation.
Thanks for having me. Really, really enjoyed it.